All right, we're going to wrap up this chapter by looking at monetary policy transmission and credit policy at today's Fed. So the Fed has sought to achieve an interest rate target. Part of what its current policy is that it's targeting a particular interest rate, but there is a fundamental tension between targeting the interest rate and controlling the money supply. Now, the Fed can attempt to stabilize the interest rate, or it can attempt to stabilize the money supply, but it cannot do both at the same time, as it turns out. And this is because of the transmission mechanism. So basically, to sort of highlight this or illustrate this, we start with the Fed engaging in a change in monetary policy. So it either decides to buy more bonds or sell more bonds in an effort to change the interest rate. In doing so, it changes the amount of excess reserves that banks have on hand. That changes the money supply, right? So we learned that in the last chapter. When banks have changes in their reserves, that has an effect on the money supply because of our fractional reserve banking system. And that leads to a change in interest rates, which changes the level of investment in the economy, which changes the level of real GDP in the economy. All right, so let's see here. In this case, we have the Fed increasing the money supply by buying bonds, right? Taking bonds from the public and giving the public cash, injecting money into the money supply. And as that happens, interest rates fall. Well, as interest rates fall, planned investment goes up, right? It becomes cheaper to borrow money, and so businesses invest more. And what does that do? Well, it increases aggregate demand, perhaps taking us out of a recessionary gap. Okay, so that's the transmission, right? It takes all of these steps for monetary policy to be transmitted to the economy. Now, the Fed can target the federal funds rate. The Fed can influence interest rates only by actively entering the market for bonds, right? Federal government securities in the open market operations. So the federal funds market, what is it? It's a private market that is made up. So this isn't the open market. This is the federal funds market, something that's another one of its policy tools. So it can change the federal funds rates by changing the aspects in the federal funds market that it can control. So the federal funds market is a private market of banks in which banks can borrow reserves from other banks that want to lend to them. So this is what I was talking about earlier, where the federal funds rate is, and I think I may have misspoke actually. I think I mentioned that this was the discount rate, but that's something different we'll talk about in a second. The federal funds rate is the rate at which banks can borrow and lend to each other in the federal funds market. And usually these are loans that are just very short term, typically only overnight, right? So when Bank of America is like, crap, we really need some cash just for a very short amount of time, but we need it now, it can go to the federal funds market and borrow monies from, say, SunTrust or BB&T, right? Which actually SunTrust and BB&T have merged now, I think. But in any case, this is the federal funds market. It's a market for banks to lend to one another over a very, very short amount of time, usually only overnight. And they lend to one another at the federal funds rate. It's the interest rate that these institutions pay to borrow reserves in the interbank federal funds market. Now, the discount rate is very similar. And this is the one that I misspoke about, sorry. But the discount rate is very similar, but instead of banks borrowing from one another, the discount rate is the rate at which banks can borrow from the Fed, okay? So this is the interest rate that the Federal Reserve charges for reserves that it lends to banks through what's called the discount window. And so this is sometimes referred to as the rediscount rate, or in Canada and England, it's known as the bank rate. Okay, so if you're ever watching CNBC, you might hear them talk about the bank rate. All right. So the interest rate on reserves, regarding that, in October of 2008, Congress granted the Fed authority to pay interest on both required reserves as well as excess reserves. So this hadn't been done previously, but of course, banks are required to hold some level of reserves, right? According to the required reserve ratio, they have to have 10%, at least 10% of the money that is deposited with them. So again, when you deposit $100, they have to have at least $10 of that on reserve. They can have more than that, in which case it's excess reserves, but they have to have at least that 10%. And in 2008 of October, the Congress said, okay, you can charge or pay interest on not only excess reserves but required reserves as well. Now, if the Fed raises the interest rate on reserves, it thereby reduces the difference or the differential between the federal funds rate and the interest rate on reserves. And so banks have less incentive to lend their reserves in the federal funds market, right? They have less of an incentive to lend to other banks when this happens. Okay. So there's something else called the FOMC directive, or the Federal Open Market Committee directive. It's basically a document that summarizes the Federal Open Market Committee's general policy strategy. So this is in an attempt to be very transparent to the public so that there's less uncertainty, which usually translates into a better operating financial system. And part of what it does is it establishes near-term objectives for the federal funds rate, and it specifies target ranges for the money supply growth. So these are the sort of what the FOMC is trying to achieve. What are its goals? It's called the FOMC directive. There's something else called a trading desk. It's an office at the Federal Reserve Bank of New York, and they are charged with implementing monetary policy strategies developed by the FOMC. So the FOMC gets together, decides what the Fed should do, and then the trading desk is responsible for putting that into action. All right, something else we need to learn about is called the Taylor Rule. It's basically a suggested guideline for monetary policy, and it's an equation that determines the Fed's interest rate target based on a few different things, based on the estimated long-run interest rate, long-run real interest rate, the deviation of the actual inflation rate from the Fed's objective. So the Fed has a target for inflation, and the difference between actual inflation and their objective is the deviation. And then it's also based on the gap between actual real GDP and a measure of potential real GDP. What could we potentially achieve as an economy? So using these different measures, the Taylor Rule spits out sort of a guideline for the Fed. So here we see the actual federal funds rate and values predicted by the Taylor Rule. So the orange line is the actual federal funds rate, and the green line is the value of that rate predicted by the Taylor Rule, or I should say suggested. It is a prediction, I suppose, but it's really more of, you're taking these values here, and the Taylor Rule is spitting out a suggestion, like what the Taylor Rule thinks the Fed should do with the federal funds rate. So you can see that, the Fed loosely follows the Taylor Rule, but it hasn't really followed it in recent years. In fact, the federal funds rate has been close to zero ever since early 2009, and it only recently started to go back up around the beginning of 2016. And now it's at zero again, actually. There's also credit policy at the Fed. So this is the Federal Reserve policymaking involved with direct lending to financial and non-financial firms. When many banking institutions were faced with possible bankruptcy in 2008, the Fed provided credit directly to them. So it's this case of lender of last resort that we talked about in chapter 15, right? So when there's drastic emergencies in our financial system, and there are banks that are on the verge of failing, the Fed can come in and act as a lender of last resort, provide them with some liquidity, provide them with some cash that they need to prevent themselves from failing. And this is referred to as the Fed's credit policy. And the Fed's credit policy results in activities more closely resembling those of a private bank than a central bank, actually. The Fed has essentially paid banks a subsidy to keep hundreds of billions of dollars on deposit. And these reserve deposits finance the Fed's credit policy of extending loans to banks, non-financial companies, and other central banks. So that's pretty interesting. Now, there are three arguments that are sort of in support of the Federal Reserve's credit policy. It gives banks time to recover from financial meltdowns. It makes financial markets and institutions more liquid and solvent. And it contributes to international financial liquidity. So these are some reasons that people think that this credit policy is a good idea. But there are some critiques of the policy as well. It provides an incentive for institutions to operate less efficiently. It reduces incentives to screen and monitor or limit asymmetric information problems. And it makes monetary policy less effective, which we may be seeing the results of currently, actually.